Hello, and a big welcome to all of you, especially any CIPS students tuning in. In procurement, every single price tag tells a story. What we're going to do in this explainer is build a financial toolkit for you so you can read that story and then use it to your advantage in pretty much any negotiation. Okay, let's kick things off with a scenario that probably feels a little too real. You open your email, and there it is. A key supplier is jacking up their prices by 15%. Now, your first gut reaction might be frustration, right? But your second reaction, that's where strategy comes in. This is all about giving you the tools to move from that gut reaction to a smart, confident financial response. So, where do we start? Well, our first set of tools is all about playing detective. See, before you can ever challenge a price, you have to understand how it was built. So let's pop the hood on a supplier's pricing and really see what's driving their numbers. When you look at how a supplier figures out their pricing, it really boils down to two main approaches: absorption costing and activity-based costing. I want you to think of it like this. Absorption costing is kind of like a wide-angle lens on a camera. It captures the whole big picture. But activity-based costing, or ABC, that's the zoom lens. It lets you focus on the tiny details with almost surgical precision. Okay, first up is absorption costing. You might also hear this called full costing, and that's because it takes all the manufacturing costs. We're talking both fixed costs, like the factory rent that never changes, and variable costs, like raw materials that do, and it just absorbs them into the final product cost. It's simple, yeah? But the catch is, by averaging everything out, it can sometimes hide the true cost of making one specific thing. Now, activity-based costing, this completely flips the script. Instead of just averaging things out, ABC acts like a forensic accountant. It directly connects costs to the specific activities that a product needs. So if your order requires a really complex machine setup or extra quality checks, ABC assigns the cost of those exact actions directly to your product. This gives you a much more accurate picture of the real cost. So, why on earth does this matter to you? Well, because when a supplier hits you with that 15% increase and blames rising costs, you can now ask much smarter questions. Is that increase coming from their general overhead that's spread across all their customers, or is it tied to a specific activity that only affects my products? Just knowing the difference between those two things gives you a massive advantage. All right, so knowing a supplier's costs, that's step one. But step two is understanding the financial pressure they're under. And for that, we need to find their financial survival line, what's called the break-even point. And that's where break-even analysis comes in. This is such a fundamental tool. It helps you find the exact point where a company's revenue equals its costs, the point where they aren't making any money, but they're not losing any either. For you, this is a critical health check on your supplier. It tells you the absolute minimum they have to sell just to keep the lights on, and that gives you powerful insight into their financial stability. So how do you find it? Well, the formula is actually pretty straightforward. You take their total fixed costs and you divide that by something called the contribution margin. And all the contribution margin is the selling price per unit minus the variable cost per unit. Think of it as the amount of cash from each sale that's left over to contribute towards paying off those big fixed costs, like rent. Once those are paid off, everything after that is pure profit. Let's just walk through a quick example so it makes sense. Okay, let's say a company has fixed costs of $10,000. They sell their product for $15, and the variable cost for each one is $5. So step two, we do 15 minus 5, which gives us a contribution margin of $10 per unit. Step three, we divide the $10,000 in fixed costs by that $10 contribution. And there you have it. They need to sell exactly 1,000 units just to break even. Every single unit they sell after number 1,000 is profit. Okay, so break even is about survival. But, suppliers aren't in business just to survive. They're in it to make a profit. And the way they calculate and talk about that profit can be, well, a little slippery. So let's add two absolutely crucial tools to our kit: margin and markup. These will help us decipher their profit strategy. Now, if you remember one thing from this whole section, make it this. People use these two words, margin and markup, interchangeably all the time, but they are completely different. Margin is profit calculated based on the selling price. Markup is profit calculated based on the supplier's cost. One looks at it from your point of view, the other from theirs. And that one difference changes everything. Let's tackle margin first. The formula is simply the profit, which is just the selling price minus the cost, divided by the selling price. So this tells you what percentage of the final price you pay is actual profit for them.
It answers the question of the money I'm about to give this supplier, how much of it is pure profit?
Let's use a really simple example from our source material. Say an item costs the supplier £50 to make, and they sell it to you for £100. The profit is £50, right? So using the margin formula, you divide that £50 profit by the £100 selling price. That gives you a 50% margin. It's that simple. Half the price you pay is their profit.
All right, now let's flip it and look at markup. And notice the key change in the formula here. The profit, still £50, is now divided by the original cost, not the selling price. This is the supplier's perspective. It answers their question. Okay, this thing costs me £50. How much do I need to mark it up to get the price I want?
And this is where it all clicks into place. Using those exact same numbers, the £50 profit divided by the £50 cost, you get a 100% markup. So a 50% margin and a 100% markup can be used to describe the exact same transaction. And this is why knowing which term your supplier is using is absolutely vital. You have to make sure you're both speaking the same language.
Okay, for our last tool in the kit, we're going to zoom out. A supplier's price isn't decided in a bubble, right? It's heavily influenced by the outside world, and specifically by their customers. So let's look at how the market and customer demand can shape their pricing strategy.
This brings us to a really important economic concept, price elasticity of demand, or PED. Now I know it sounds a bit academic, right? But all it really means is how sensitive are customers to price changes? If a supplier raises their price, how many customers are they actually going to lose? Understanding this helps you figure out how much pricing power your supplier really has. And the formula itself is pretty simple. It's just the percentage change in the quantity people buy divided by the percentage change in price. I mean, think about it. A supplier selling a luxury sports car, they're probably going to lose a lot of customers over even a small price hike. But a supplier who sells a critical, patented medicine, they can raise their prices a lot and probably lose almost no one. One has very little power, the other has all of it. So this really breaks down into 3 key types. If demand is elastic, customers are super price sensitive. A small price increase will cause a huge drop in sales. Think about anything with lots of alternatives. But if demand is inelastic, customers are not sensitive to price. They'll pretty much keep buying even if the price goes way up. This is where you find those critical sole source parts. And this is exactly where a supplier gets the confidence to send you that 15% price hike email. There's also unitary demand, but elastic and inelastic are the 2 you'll really see in the wild.
Whew! We have just covered 4 really powerful financial tools. We've gone all the way from a supplier's internal costs to their position out in the wider market. So let's just do a quick recap of what each one of these brings to your brand new toolkit. So first, you've got your costing methods, which let you understand how they build their price. Then there's break-even analysis, which helps you assess their financial risk and stability. Margin and markup let you deconstruct how they build profit. And finally, price elasticity helps you gauge how much the market is affecting their price. Each tool gives you a totally different angle to analyze a supplier's position. And that brings us full circle, right back to where we started. That 15% price increase email is still sitting in your inbox. But now, you're not just reacting. You have a full financial toolkit at your disposal. So the final question is for you. Which tool are you going to reach for first to challenge that increase and strengthen your position? Your strategic response starts now.